Two buyers are looking at the same type of business, same purchase price, $900,000, same annual cash flow, $250,000. They both hire brokers, fly out to visit the locations, pay for due diligence, and make offers. Buyer A gets an SBA approval in a matter of weeks. Buyer B spends 4 months answering lender questions, producing additional documentation, and defending numbers that looked identical on paper, and still does not get funded. The difference was not the business. It was how much the lender had to assume to say yes. If you are evaluating a business purchase and you have never thought about how a lender reads your deal before you walk into a bank, this video is the one to watch first. There are 5 specific factors that determine how a lender sees a franchise versus an independent business. Most buyers never learn any of them until they are already inside an approval process that is not going the way they expected. We call this framework How Lenders Read the Deal, and we are going through all 5 today. Welcome to Main Street Ledger. We cover small business acquisitions, SBA lending, franchise ownership, and business finance, all drawn from public sources. If this is your first time here, subscribe below. This is research and education, not financial, legal, or investment advice. Here's the assumption most buyers carry into a lender conversation. They assume the lender is doing roughly the same analysis they are, looking at the price, looking at the cash flow, checking the industry, and deciding whether the numbers make sense. That assumption is mostly wrong. Lenders are not evaluating what a business earned. They are evaluating how confident they are that it will keep earning after the current owner leaves and a new one takes over. That is a completely different question, and it drives everything. The approval decision, the timeline, and how much money you need at closing. Buyer A and buyer B both believe they found good businesses. Their brokers confirmed the cash flow. Their accountants reviewed the returns. But the lender is not running the same analysis the broker ran. The lender is building a case around uncertainty, how much there is, where it comes from, and who carries the risk if the numbers do not hold. By the time we finish all 5 factors, you will understand exactly why 2 identical deals produce 2 completely different outcomes at the loan committee. Factor 1 is the history advantage. When a lender reviews buyer A's franchise, they are not limited to the seller's tax returns. Many established franchise systems provide performance data from existing operators, unit economics, cash flow ranges, how the model performs across different markets and different ownership teams. That information often does not exist anywhere in an independent business acquisition. The lender is benchmarking buyer A's deal against a population of real businesses running the same system. That is a fundamentally different underwriting experience. There is also something experienced SBA lenders rarely talk about publicly. Many of them have financed the same franchise brands repeatedly. That familiarity reduces uncertainty before the file even reaches credit review. Buyer A benefits from every prior approval the lender has made in this brand. Buyer B's independent HVAC company has one data point, the seller. 3 years of strong returns and a set of open questions the lender has to answer without any comparable history to reference. The SBA maintains a franchise directory that lenders use when evaluating franchise financing. Under the SBA's current lending framework, franchises listed in that directory allow lenders to move forward without an additional franchise eligibility review. That step, when it is required, adds time, and it is required for any franchise not on the list, regardless of how strong the deal looks. The directory is a free download at sba.gov, and we will link it directly in the description. Check it before you have any other conversation about financing a franchise. Buyer A's franchise is listed. The lender moves forward. Buyer B's deal has no comparable operators and no directory shortcut. The questions begin. Factor 2 is the assumption penalty. Most SBA lenders want to see that a business generates enough cash flow to cover the loan payment with meaningful room above it, typically around 25% above the debt obligation. For a business with clean, verified performance history, the lender can confirm that number is real. When the lender cannot fully verify the story the numbers are telling, they do not necessarily decline. They price the uncertainty into the deal structure. Let me show you what that looks like for our 2 buyers. Buyer A is purchasing the franchise. The lender has operator performance data, a clean disclosure document, and familiarity with the brand. Lenders may approve a buyer at or near the SBA minimum equity contribution when the deal carries lower uncertainty. For buyer A on a $900,000 transaction, that is roughly $90,000 down. Buyer B is purchasing the independent HVAC company. The cash flow looks identical on paper, but the lender cannot verify what happens after the seller walks out the door. In cases like this, lenders often require a substantially higher equity contribution and sometimes double the minimum. For buyer B, that conversation lands around $180,000, same purchase price, same cash flow, an extra $90,000 out of pocket before either buyer earns a dollar. For many buyers, that is not the difference between a good deal and a bad deal. It is the difference between buying a business and staying on the sidelines. That gap is the assumption penalty. It is not a fixed rule, and it is not automatic. Loan structure, seller financing, collateral, and borrower background all play a role. But the direction is consistent. More uncertainty, more equity required. Imagine buyer B at that moment. 6 months of searching, due diligence fees paid, an offer accepted. And now a lender is asking for $90,000 more than the plan required because of a factor buyer B never knew to ask about before making the offer. Factor 3 is the operator test. Once a lender has assessed the business, they assess the buyer. The question is not whether you have a specific credential or a set number of years in a particular industry. Lenders look at the full picture: management experience, operational background, ownership history, and relevant skills. The question they are trying to answer is whether there is enough evidence to believe you can run this business successfully after the transaction closes. Buyer A has limited direct experience in the home service industry, but the franchise comes with a structured training program, an operational playbook, and ongoing support from a team whose job is to make new franchisees succeed. The lender sees a gap in buyer A's background and a system designed to close it. Buyer B has the same limited experience. The independent HVAC company has no training program, no playbook, and no support structure. If buyer B does not know how to run a field service operation, nothing in the deal compensates for that. The lender is now carrying two uncertainties at once: an unverified business performance and an unproven operator. SBA's current lending guidelines require lenders to document and evaluate the buyer's relevant experience. A franchise's training infrastructure is one form of evidence that operator risk is being managed. An independent business purchase offers none of that offset. Factor 4 is the transfer risk. Think about a business where the owner is the business, a dentist with a loyal patient base built over 20 years, an insurance agency where every major account knows the principal personally, a commercial HVAC company where the owner's phone number is the reason clients call back. What is the lender actually financing when that owner leaves? That question matters far more to a lender than what happened in the 3 years before the sale. The seller's tax returns show what the business earned while that relationship was intact. They do not show what happens on day one after the transition. The customers who called because they trusted the previous owner, do they stay? The employees who showed up because they respected the founder, do they follow him out? This is transfer risk, and it exists in every ownership change. But it is most acute when the business's value is concentrated in a person rather than a system. Buyer A's franchise does not carry that risk in the same way. The brand belongs to the system. Customers chose the concept, not the individual operator. The training, the supply chain, the customer-facing identity, all of it continues through the transition independent of who is running the location. Buyer B's HVAC company is a different story. The lender does not know how much of that $250,000 in annual cash flow walks out the door with the previous owner. That uncertainty is transfer risk, and lenders require more from the buyer when it is present. Factor 5 is the financeability test. Buyer A is operating the business. Buyer B is still trying to get approved. Before you make an offer on any business, ask yourself one question: what assumptions does the lender have to make for this deal to work? If the lender can benchmark performance against comparable operators, that is fewer assumptions. If the lender can see that the business model survives ownership transitions, fewer assumptions. If the lender has evidence the buyer can operate what they are purchasing, fewer assumptions. Every assumption the lender carries is a variable they cannot control, and lenders respond to uncontrolled variables by requiring more from the buyer at closing. A franchise does not automatically pass the financeability test. There are franchise systems with weak unit economics, thin operator data, and names that do not appear in the SBA directory. But a franchise addresses the lender's core concerns in a structural way that an independent business cannot replicate. That structural difference is what produced two different outcomes for two buyers who believed they were looking at the same deal. Here is what to take away from this video. Lenders are evaluating uncertainty, not just profitability. Two deals with identical numbers can carry completely different approval risk based on how much the lender has to assume. The assumption penalty is real. When lenders cannot verify performance, they often require more equity. On a $900,000 deal, that gap can determine whether the deal happens at all. Your experience matters to the lender as evidence, not as a credential. A franchise's training program addresses operator risk in a way an independent business purchase cannot. Transfer risk is the factor most buyers miss. The seller's track record does not automatically follow the buyer, and lenders price the uncertainty of that transition into the deal structure. Check the SBA Franchise Directory before pursuing any franchise opportunity. Listed franchises often move through the financing process more efficiently because additional eligibility reviews may not be required. The link is in the description. The best business is not always the one with the highest cash flow. Sometimes it is the one a lender can say yes to. If that changes how you are thinking about your search, subscribe. The next video in this series takes on what happens when both options are startups, a new franchise versus a new independent business. They are both building from zero, but lenders do not see them the same way. Research the deal before you fund the deal.